So in this section, we'll be looking at cash management. So what is the objectives of holding cash? There are like three motives. The first one is transaction motive. That is, cash is required to meet the day-to-day expenses of the business. So cash is held by the company to pay rent, payment of salary, etc. It can also be held for a precautionary motive, such as cash held for unplanned expenditure. It can also be held for speculative motive. That is, cash can be kept to take advantage of investment opportunities. So we don't know like when investment opportunities can come up. So the company is always having a reserve of cash so that they can use it for such purposes. So these are the objectives for holding cash. So we'll have a quiz. Which of the following statement most accurately describes a key aspect of managing a firm's net daily cash position? So it helps to analyze cash inflows and outflows to forecast future needs for cash. That is the right answer. Maximize the firm's cash inflows and minimize its cash outflows. So we are not trying to do an NPV problem or a net present value problem here. So this is not the right approach. The next one is minimize uninvested cash balances because they earn a return of 0. So we are not trying to minimize the uninvested cash balances and all. So again, that is a wrong answer. So the answer is A. We have another quiz. Which of the following would most likely be considered a disadvantage for a company to maintain a high levels of cash? Holding cash ensures liquidity. That's a correct one. That's not a disadvantage. Occasionally, the company has an opportunity to buy inventory at a substantially reduced price. So again, that is an opportunity. Investor dissatisfaction with the firm's asset allocation. So that can be the answer because the company is holding high amount of cash and it's not invested it properly. So the investors can be dissatisfied. The ability to cope with unexpected events. Actually, when you have more cash, you can cope with unexpected events. So the answer should be C. The answer is C. So there are like two models for cash management. The first model is called Baumol model of cash management. This model, also known as the inventory model, was developed by William Baumol and is based on the combination of inventory theory and monetary theory. According to this theory, the optimum level of cash is that level of cash where the cost of carrying and the transaction costs are minimum. Here, carrying cost means that the interest foregone on marketable securities, and transaction cost refers to cost of liquidating the marketable securities. The optimum cash balance according to Baumol is C equals to the square root of 2 into D into F divided by O, where C refers to the optimum cash balance, D refers to annual cash disbursement, F refers to fixed cost per transaction, O refers to the opportunity cost. So this model is like very similar to the EOQ model. So EOQ model tells you what's the optimum level of ordering quantity, and this model tells you what is the optimum level of cash that a company can have. So both models are using the similar approach. So there are some assumptions which are made in Baumol model. Cash needs of the firm is known with certainty. Cash disbursement over a period of time is known with certainty. Opportunity cost of holding cash is known and remains constant. Transaction cost of converting securities into cash is known and remains constant. That is, all the variables in the formula are known with certainty, but in reality, these assumptions might not hold true because the company cannot estimate its cash needs perfectly. It cannot know like when the cash would be required for disbursement will not be known again exactly. The opportunities keeps on rising again and again in different form. So the opportunity cost will differ in different scenarios. The transaction cost of converting securities might be known with a little bit certainty. So out of these four assumptions, three might not hold properly, but one alone might work. The Miller and Orr model of cash management is one of the various cash management models in operation. It is an important cash management model as well. It helps the present day companies to manage their cash while taking into consideration the fluctuations in daily cash flow. So we'll see how the Miller-Orr model works. So Miller says that with computation, okay, with equations, we can find out what is an upper control limit and what is the lower control limit. So this is the point. Okay. So the lower control limit is set here and the upper control limit has been like set here. And he also says there's something called as a return point. Okay. So these are the three variables which are important from Miller-Orr model: the upper control limit, the lower control limit, and the return point. So if you look at this curve represents the cash balance of the company. So whenever the curve touches the upper control limit, he says the company should use the excessive cash position, okay, and they have to buy the difference from here to here as purchase of market security. So he says deposit in a market security, in a very liquid security. And at the same time, if the cash position reaches the lower control limit, he says from the lower control limit to the return point, this amount of securities should be sold in the market and the cash should be raised to up to the return point. So it works like this: whenever the upper control limit is touched, the difference between the return point and the upper control limit are invested in the market security, and whenever the cash position reaches the lower control limit, the difference between the return point and the lower control limit are sold in terms of the market security and cash is raised. So control limits act as the barriers. It should not like cross over that. The cash position should not cross the upper control limit nor the lower control limit. So how do we find the upper control limit and the lower control limit and the return point? So he has created some formulas for that. As per the Miller-Orr model of cash management, the companies let their cash balance move within two limits: the upper control limit and the lower control limit. So here's the explanation for the diagram. Along with the return point, when the cash balance touches the upper control limit, the H, the marketable security is purchased to the extent till it reaches the normal cash balance, that is the return point. In the same manner, when the cash balance touches the lower control limit or O, the firm will sell the marketable security to the extent till it reaches the normal cash balance of the return point, which is again the Z. So this is how the upper control limit is like calculated. He says it's lower limit plus the spread. So lower limit will be like given in the question. The return point is calculated with lower limit plus 1/3 of the spread. So now we need to know like what is the spread, because it's like used in the formula. So spread is the Z, 3 into 3 by 4 into transaction cost into variance of cash flow per day divided by interest rate per day to the power of 1 by 3. So how do you calculate this? First you calculate this part, okay, for the resulting answer. So first you calculate this part. The resulting answer is taken to the power of 1 by 3. That answer should be then multiplied in the third step of into 3. So only when you do it in the sequential manner you get the answer. So the variance of cash flow per day is calculated like this: variance of cash flow equals to standard deviation square and interest rate per day is equals to interest per annum divided by 365 days. So these are the computation. Mostly if the question is asked in a 2 mark, all the numbers would have been given directly to you and you just need to find out the spread, or sometimes the spread could have been like given your and lower limit will be given, so your job is to just find out the upper limit or the return point. So this question, so the computation actually becomes very simple in the exam. So we look at the last part of the chapter, which is short-term cash investments. Short-term cash investments are used to park temporary cash surpluses. The following are the trade-off for short-term cash investments. So when a company has excessive cash, they could invest in short-term securities. So when they invest in a short-term security, they should give consideration to these three things. The first one is liquidity. That is, cash must be available when required. See, what we do here is we are like investing the cash which is excessive. So we should not be like investing it in a very long term duration security and all. We should invest in a security which is very short term in nature. That is, if we want money, we should be able to sell the security even in one day. Okay, so that is a very important point, because if you're going to invest it in a security which has a lock-in period of 1 year, then it is of no use. Okay, so whenever the cash is needed, the security should be sold in a single day itself. The second one is safety, not risk the capital part of the investment. So we are trying to make a small additional gain in terms of an interest. We are not trying to make a huge amount of return and all with this short-term cash investment. So we should not take risk with the full capital itself. For example, if there's a 1 lakh rupee of cash surplus, the company should not like take risk and then try to earn something like 1 lakh 10,000. That is not the game. The game is to earn even at least 1 lakh 1,000. Even 1,000 rupees incremental difference is more than enough, but we should not take risk. That is what they say. So the safety is very much important of the capital. The next one is profitability. Sorry. Assume that a marketable security gives you high liquidity and high safety, but lower profitability. That is the security which we should invest. We should not be like investing in a market security which gives us low liquidity, low safety, but high profitability. We are not aiming for that kind of high profitability. The profitability is, assume that market security is like this, which offers us high liquidity, high safety, and a nominal profitability. Among those securities, assume that there are like two securities, security A and security B. Security A offers you 2% return, security B offers you 2.5% return. Then which you will select? You will select the B1, which gives you the 2.5. So he's just saying that the company needs to earn a higher after tax return, but not compromising these two aspects. So we'll have a quiz. Which of the following investment is not acceptable as a way for companies to invest short-term cash surplus? So which of the things we should not invest in our cash surplus? Bank deposit. So we'll see all the options and we'll find out the worst option. Bank deposit, ordinary share, certificate of deposit, treasury bill. If you look at all these options, bank deposit is a part of money market, certificate of deposit is a part of money market, treasury bill is also a part of money market, but shares is part of the capital market. So money market deals with short term funds and securities, capital market deals with long term funds and investments. So B should be the answer. We should not invest our cash surplus in ordinary shares because it is very risky. The answer is B. So we'll look at what are the questions that have been come from this chapter in the past exam. So from the introduction to working capital, we have got these questions. From over trading and working capital cycle, we have got these questions. From cash management, area, we have got these questions. From receivable management, we have got these questions. Again, from receivable management, we have more questions. Thank you very much for watching the video. We'll meet in the next video.